money, so he's the most important person. And Jim Walker, who's like doing that one camp. And we have Abraham Lincoln as a special guest, who also does like assist.
My name is Abraham Lincoln III. I have a speech at the very end. I redid the...
Tone it down, Abe.
Tone it down.
We're going to get George Washington next. Depending on the holiday. Okay, we're an ongoing economic and investment seminar. So we're an educational group. We're here to teach you things or help you learn things about the market. We don't tell you buy like XYZ stock at $165. Sell it 2 days later. And we provide the big picture. We try to provide you unbiased stock market education and information. And you cannot get that in the papers or on TV. Everything you're hearing is biased. It's almost everything. The Wall Street spends a fortune on public relations to get things in TV and in the press. And they do that to make themselves money, not to make you money. And the only person that really cares about you making money is you. So always remember that. Well, presumably you care, right? That's why you're. So we want to get to the point where you can make your own investing decisions. And that requires some effort, and people hate that. The moment you say you have to do work, they run away. So our offerings, we have general meetings. We're in a general meeting right now. This is once a month, and it's on broad topics. We used to have classes. We'd like to start in the beginning. We could actually start in the beginning. Those are on very specific topics, like technical analysis or ETFs or something like that. And only one topic in the class, only one subject. And we might move to webinars instead of having meetings. We'll always have physical meetings, but not every meeting. And you can have individual instruction. We're trying to set up something through Skype or Google Plus, probably Skype. We currently have 7,150 members. We're the largest investing meetup in the world. We had 20 people when I walked into this group many years ago, almost 10. Back 10 years ago, I've been the organizer for 10 years as of this month. I actually forgot that. So, and we accurately predicted the credit crisis, the bear market, the recession, 2007, 2008. So we grew from just a few people to like a very big group in a couple of years. And we were the first meetup in the world to use YouTube, and that was in 2007. Now everyone uses YouTube now. But like back then, it was sort of a new thing, it's sort of unusual, and you forget once you start using something that like at one time it didn't exist and it was uncommon. And the notes for the first meetup, I have a blog, published directly. I write articles usually for Seeking Out, and some other websites too. The notes for our meeting since 2007 can be found on our website. And in the file section, it's really hard to follow. But if you just put in our URL and /files, you'll find years and years and years and years of notes. In case you like have insomnia and you can't go to sleep at night, you're like, oh, I'll read some of these. Now, we're in social media. I tweet at NY Investing. I have 4,000 Twitter followers. And there's a Facebook fan page, which I haven't looked at recently, but because I'm frightened to. But like, we won't name names if it takes care of that. I'm on LinkedIn. I have close to 5,000 LinkedIn connections. If you're a professional, like to connect. As I said, I write articles. I usually publish them on Seeking Alpha. Sometimes Talk Markets, Investing.com, and Equities.com. Usually 3 other sites. And we have videos. We take videos. I never know what happens. And our long-term goal is we'd like to create like an internet TV channel. And here's our website. We have some sponsors. You should look at them. They're on the left side. Housekeeping. We're always looking for volunteers because there's actually a lot of work to do to run the meetup. You're going to get some email rate the meeting. Please do that. You need to be out if you're at 8:30 because we pay rent for this room, and the rent runs out at 8:30. So we're like always on a tight schedule. And we go to a bar afterwards. You're all welcome to come with us. You don't have to drink. You can eat something. You can have a soda. You don't have to drink alcohol. We don't force you to do it. So you're all welcome to come with us. So books, I've written a whole bunch of books. The first 4 were on inflation investing. That's really commodities investing. and then shorting bonds and a few other things, buying collectibles, antiques. And I have been working for a book on crowdfunding for quite some time. And I wrote a book about the presidential election, so we're having a presidential election talk. So it's like I have some ability to analyze the election that you're not getting in the press. Almost everything you're reading is a complete lie, and we'll discuss why. And I used to be a political pollster myself, and I have never seen that polls are total garbage. You shouldn't believe any of them, which is a problem. Sometimes you can believe some of them. So, like, what's really going on is really and so, like, all my books are on Amazon. I wrote a book about Trump. I'm a Trump analyst, or Trump, like a China expert. When years ago, when China was closed, there'd be these China people who analyze the secrets of China, trying to guess what. Well, I'm like that person for Trump. What is he really doing? What is he really? And they try to read these coded messages and see what's really is. So these are what the inflation books look like. Tonight's agenda. David is back. He was in England, so we're very grateful he's here. And he has a market timing model. He's worked in this model for 10 years. And he has a PhD, so he's an experienced researcher. And it predicts market tops, bottoms. It's really market timing. And of course, we're trying to predict the top, of course, so at least in stocks, and maybe a bottom in commodities. So, like, different assets are top and bottom at the same time sometimes. We'll discuss what's going to happen in the presidential election, and then there'll be an update on the markets at the end. There'll be a little intermission in the middle. So this is a lot of material to cover. So we're now going to see introduce David Harris, who hopefully... No, that's not it.
I can talk to that one.
Oh, well.
Very, very bad.
Yeah, we'll do what you want.
I know nothing about the election.
You know it?
I know nothing about it. It's good. Hi everybody, thanks for coming along in such terrible weather. I'll give you an update on what I think is happening in the markets right now, what's going to happen going forward. I've got a new signal to share with you, which is quite interesting. It really predicts that no matter who wins the election, the chances are the market will go down from here. Just quickly racing through the first few slides that I cover each month. I've got a signal back over 2 years ago now saying that a top was likely in these markets. From that, I'm going to calculate on the weekly charts. This is a weekly chart of the Dow Jones. A number of windows of opportunity where a top might happen. And there's also two other windows which this year, one we've passed through, which was earlier this year, and number 6, which is what we're in now. I'll show you those in later slides. They don't fit on this slide. On the daily charts in blue there was a couple of other windows I could calculate. So where window B and window 4 overlap, there's a good chance there'd be a market top. And sure enough, there was. Going forward from that point, we had a series of all the key indexes in America, all topped out in that window 4. 7 different indexes, including the Dow Jones, the S&P 500, and so on. It took about 48 weeks from the signal to the top. That's about average, because the average is 39. And the market dropped 16%. A minimum of 12% is expected. So once it dropped 16%, a good chance that that was recording a significant high, if not the top. However, what we know has gone forward from there. We then traded in a range from last summer up until the end of last year, down to the spring, and the blue lines show the range we've been. We went up to the top of that range into window 5. Window 5 was March, April and May last year, earlier this year rather. And we didn't create a new high, but we did have a slightly lower high. That, to me, suggested the market was weakening. But as we've seen over the last few months, it actually did get strength again and has gone higher again. Let's have a look at that. There were 2 levels of support through the summer. One we hit in May, that's 17,400 and that, and then with the Brexit vote, and that we bounced off 17,100 up to a new high. So now we're looking for a market top potentially this year, 2016, rather than 15. We do know now that window 4 and 5, like 1, 2 and 3, are no longer the top. So we've got window 6, which is Q4 this year, so we're in that right now. And it's likely then we might see a significant high or top in the next few weeks. There's also another window, but window 7 doesn't happen until early 2018, so that's well over a year away. So there's no windows at all next year, suggesting some weakness next year. We come down into October. Now this downward move is somewhat sideways. We're very close to the end of that chart, finishing a low on the daily chart. This is a weekly chart. But on the daily chart, this almost looks like it's come to an end. So somewhere between now and either late October, Monday, or early November, we might hit a low point, and then there's a possibility we might bounce up from there. And we might bounce up to a new high. Usually when you reach a high on one of the indexes, there's an attempt to take that high out and go higher still. If it succeeds, then you go higher, you've got a new high. If it fails, you've got a lower high, that shows weakness in the market. So potentially there'll be another attempt to take out the previous high, which had back in August. From there, I think we'll come down quite strongly, and I'll show you why in a couple of slides, why I think we'll come down from that point.
David, is there a reason why you're focused on the Dow Jones and not more broader indices? That's only 30 stocks, right?
Yeah, I've got data back to 1885. So you've got the Dow goes back to 1885, so I've got enough data. I can backtest all of my models way back further than any of the other indices. I do look at the S&P 500 and then after you'll see those come on later on. But I focused initially on the Dow because I could test all of the models way back over 100 years, 130 years at this point. And funnily enough, the models show the same kind of results all the way back 130 years. So there's consistency in how the market operates in all that time. So the Dow has gone up just about 1.5% since the top, or what we thought was the top, but the high in May last year. S&P 500 is similarly about 1 or 2% higher from the May high last year. Nasdaq Composite a little higher from the I think June or July last year, and then the Nasdaq 100 actually peaked out later last year in November, I think it was. But again, they've gone a few percent higher. Russell 2000 actually is lower, so the small cap stocks are weaker. And the Dow Transports is quite a lot weaker, so it's actually nowhere near the high that it reached at the beginning of 2015, end of 2014, beginning of 2015.
So they've not confirmed the number of times.
Yeah, well, there's a Dow theory. I don't follow it very closely. However, usually when the two top out together, that's a signal. But the fact there's a lot of weakness here is some concern about the current top that's forming, or current high that's forming. Now, the reason why I think the market is likely to go down from here, I'll show you. This is a long-range view of the Dow. It's a quarterly chart, so each candlestick is 3 months of activity, so it's quite long range. It shows from 2007, the top in 2007, which was the top we all remember back a decade ago, the bottom in 2009, and then there's a pattern forming here. There's a phase 1 change in direction, a phase 2 acceleration, which is 9 candlesticks all in a row, consecutive candlesticks, and then 13 more, in this case 12 at the moment. Phase 3 usually consists of about 13 candlesticks, dotted line at the moment, because at this point in July it hadn't completed, July last year. We had candlestick 12, so it almost hadn't completed. And that's why at that point I thought maybe the top was last spring, because I didn't think there was enough momentum to keep going. I was wrong, and what we're seeing now is that we had, at the end of June this year, we had an all-time closing high on the quarterly chart, which showed that there was still a lot of strength in the chart, and that's just after the Brexit vote in Europe. And then we had the potential in July of the candlestick 13 completing at the end of Q3 in September. And looks like we were going to get there, and we actually did get there. So that phase 3 is now complete. We did get candlestick 13 in Q3 this year, and that is a significant pattern, and I'll show you what that means. I do think we'll come down from here, got a general decline in volume, and the reason why is I've looked back to 1950 on the Dow Jones. I've got a chart here of all the times that pattern has occurred since 1950. So right now, there are 7 times it's occurred. This is the first one, or this is the most recent one. Reached count 13. I don't know what the market top or lower drop will be, question mark. If you go back previously, 1997 was a particular high. Reached count 13. The top of the market was 2 quarters beyond that count 13, and the low was 3 quarters beyond it, and it dropped 17%. 1992, again, reached count 13. The top was in the same quarter that it reached count 13, and the market was 6 months later, 2 quarters, which is a drop of 10%. 1983, same thing, we had a count of 13, 2 quarters later was the top, 5 quarters later was the low, and that was a 17% drop. If I go through the others quickly, you'll get the picture. So there were seven times, including the most recent one we're seeing now, back to 1950. And if you look, usually it's 0, 1 or 2 quarters beyond the count 13. We're already 1 over, because it was the last quarter we had the count 13. We're already in Q4 now. So either this quarter or next quarter could be the top. The low is usually anywhere between 2 and 8 quarters later. And then the drop is anywhere between 10 and about 30%. The average is 20%. And that's going back to 1950. So
Can I ask you a question, David? in the times where the market top was not the same quarter, say
Yeah.
2 quarters later,
Yeah.
did you look at how much the market went up on average
I haven't,
and then
but
declined?
I haven't, but I can do that.
Okay, just
But
curious.
the point being that if we go back to that point there, somewhere between now and the end of March,
Right.
there's not 100%, because my models don't work perfectly. There's a good chance we might see a top either this quarter or next quarter if we didn't see it last quarter. And then we're going to have somewhere between 2 and 8 quarters, which is 6 months or 2 years before a low is formed, and an average of 20%, somewhere between 10 and 30%. So that's the signal that I want to present today in terms of what may happen in the next coming weeks and months. One of the models I've shown you before, looking at flash crashes and waterfall drops in price. This is a model I came up with almost a year ago now, November last year. And the outputs from the model, which are the red marks here, show significant drops in the market, 2 of which, in circles here, were flash crashes. So it's got a fairly good chance of identifying the next flash crash, and certainly a very good chance of identifying a significant waterfall drop in the market. Just looking very closely at what's going on right now. August last year, that was the signal, and we saw a drop then. Had a signal in January, the 2 future signals in May and June. They've actually moved out, and I'll show you that in a moment. In January, we did see a drop down significantly, so that signal also was positive and true. Through the summer, those signals have moved out to August, October, and later on to the end of the year. We saw a big spike up and a big rally. We saw a waterfall drop of 2,500 points at the beginning of this year. And then moving forward, we're now at December and February, so we have 2 signals straddling the year end. So at the moment, if they don't move, we potentially could see a drop down into year end. But if the rally goes higher from here, it might move out a little bit further. But certainly on this model, there's again a possibility of a significant drop somewhere towards the end of the year, beginning of next year. This is another model similar to that one, but on a larger timescale. It identifies something more significant, the bear markets or US recessions. This is a long-range view of the Dow Jones, the weekly chart. We've got signals back in the 80s, one at the end of the 2000-2002 drop, 2007-2009 there were 4 signals, and we've just had one at the end of last year. Just quickly in that circle there, in the 1980s we saw a signal for the crash in the markets in 1987. That signal was actually possible to calculate a year before, so even though it happened after the drop, calculate its presence at least 6 months to a year before it. So it was before the event of the crash itself. And again in 1990, the signal is a couple of quarters later, but could be calculated 6 to 9 months, if not 12 months before that drop actually happened. Looking now where we are, current time frame, we've seen a drop with a signal both either side in August last year and then winter this year. We've got 2 signals, end of this year, Q4, beginning of next year, and then end of next year. So something's going on over 2017, unless these signals move out. And if the market were to go higher, they would push out a little bit further. But at some point, they're indicating something is likely in terms of a downward move in the market. Very quickly looking at US recessions, model from the St. Louis Fed, May to October, we've seen a flip-flop pattern here, where the signal's coming as a warning and then being removed. So back in May we had no signal, then in June we had a signal that was removed in July, back again in August, and then gone again in September and October. So we're flip-flopping back and forward, so it's potentially that we're moving into recession, but it's not a firm signal yet. I would need 2 or 3, probably 3 months of continual signals for that to be a strong warning signal, but we're possibly teetering on the edge of going into recession. Looking at GDP, which is a real-time estimation published by Atlanta Fed. It's called GDP Now, if you want to look up on the internet. Going back to Q1, started off with quite a high value, about 2.5%, came down significantly for the final value of 1.1. For Q2, we had a high value at the beginning and it came down significantly to just under 2% with the final value reading at 1.4%. And here we are now for Q3. We started off again at a high value, but as we've seen in the last 2 quarters, significant degradation in the value coming down through the readings. 2% was last week, and we just today had it clip up a little bit to 2.1. I think tomorrow we get the first initial estimate of Q3 GDP from the BEA. Just some further analysis looking at the Russell 2000 and the VIX. The Russell 2000, and there's the pattern at the end of last year, with a phase 1 change in the middle of last year, and then a move downward. And by the end of the year, we'd reached 6 candlesticks on phase 2, and we require 9 candlesticks, so 3 more